The S&P 500 is almost synonymous with investing at this point, with pretty much every beginner investing video mentioning the S&P 500. However, navigating the multitude of ETF options can be daunting, and how do you actually invest into it if you decide you want to? Well, in this video, I'll go through a step-by-step guide on exactly how to invest into the S&P 500. While the actual steps of investing are pretty straightforward, choosing the right ETF and understanding the differences is where it gets a bit more complicated. I can pretty confidently say this will be the most in-depth video you've seen on this topic, as most other videos just stop at Vanguard. Instead, we're going to explore a variety of different options, explain the differences, and help you make a more informed decision. Now, this is not a video going into whether an S&P 500 ETF is suitable for you. I have no idea. I'm not a financial advisor, and this is not investment advice. Instead, this is informational. It's a how-to video, and it gives you guidance on what the different options are and what the differences are between them. The final decision is yours, and always do your own research before making any investment decision. And of course, remember, when investing, your capital is at risk. Okay, before we dive into the how, let's briefly discuss the what. The S&P 500 is a stock market index that tracks 500 of the largest publicly traded companies in the United States. It's market cap weighted. So what this means is, the greater the market value of a company, the greater the weighting it has in the index. So for example, a company with a market capitalization of $1 trillion will have twice the weighting of another company that maybe only has a market cap of $500 billion. This means that larger companies like Apple and Microsoft have a greater impact on the movement of the S&P 500 day to day than the smaller companies in the index. Their performance matters more, so to say. The beauty of an index, though, is in its natural rebalancing. This is a key benefit. It evolves over time to reflect the state of the stock market. If the giants get smaller and another company comes rising up, then the weightings will change to reflect this. It will always be an accurate representation of the current state of the US stock market. In other words, if you invest into an S&P 500 fund, you're always investing in the market leaders of today, not the giants of the past. As of making this video, the top 10 companies in the S&P 500 organized by weighting are Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Berkshire Hathaway, Broadcom, Alphabet Class C, and Tesla. So Alphabet has Class A and Class C shares. That's why it appears twice. This list of big names is one of the main reasons why investors are attracted to it. Who doesn't want to own a piece of these tech giants? It's also an index that is endorsed by renowned investors like Warren Buffett, with him stating that a retail investor simply just needs to invest in the S&P 500. And whilst the S&P 500 has had pretty poor performance so far in 2025, overanalyzing the short-term performance of any index is pretty pointless, to be honest, when you remember that investing is meant to be for the long term. And to be honest, there's always going to be ups and downs in the stock market. There might be negative years, negative couple years, but over the longer term, whilst past performance does not guarantee future results, the track record of the S&P 500 has been pretty good, and so far it has a 100% recovery rate. Of course, I do have to stress, past performance does not guarantee future results. Okay, now that we've covered the basics, let's walk through the steps of how to invest into the S&P 500 on Trading 212. Now, I'm using Trading 212 because it's one of my favorite investment platforms, but these steps will be pretty similar regardless of which platform you use, and you can follow along. And if you are new to Trading 212, you can get a free fractional share worth up to £100 by signing up through the link in my description. Alternatively, if you're watching on TV, you can scan the QR code on screen with your phone and sign up that way. And if you're already signed up, within 10 days of opening your account, you can go to the menu page, go to the use promo code section, type in Tom, and if you apply that code, you'll get your fractional share worth up to £100. Now, this is an affiliate link and code, so what that means is if you use it, I do get something too. Thank you, I really appreciate it, and it helps make this content possible. Okay, so once you're on your platform, the first step is making sure you're choosing the right account. On Trading 212, there's a Stocks ISA account and an Invest account. Now, Stocks ISA is shorthand for Stocks and Shares ISA. For UK investors, it almost always makes sense to use a Stocks and Shares ISA over the Invest account as long as you've got ISA allowance left over. This is because within an ISA, all your investment gains, dividends, and interest are completely free of UK tax on capital gains, dividends, and interest. Okay, the next step is deposit funds. Simply deposit into your investment platform however much you want to invest. This might be a lump sum, or common practice is to invest monthly, have it as part of your payday routine, invest a small amount for your future. But it's completely up to you. Okay, the third step is you actually need to search for an S&P 500 ETF. So on Trading 212, you go to the magnifying glass, search S&P 500, and then you're greeted by so many different results. And we're going to go more into detail about this later in the video. But first of all, a few couple things to make sure are that you actually go for an S&P 500 ETF, which is the whole S&P 500. For example, IITU here, this is an S&P 500 information technology sector ETF. So you're not getting the full S&P 500 exposure, just exposure to one sector of the index. You might be looking for that, but in this video, we're talking about the full S&P 500. The other thing to look at is the trading currency, the currency that the ETF is listed in. So if you're a UK investor holding GBP, Great British Pounds, you probably want to look for one that is traded in pounds or pence. This means that when you invest into it, you won't have to pay any foreign exchange fees. Whereas on the other hand, if you go for one that's listed in USD or euros, then there will be an FX fee to pay on transaction to convert your pounds in your account into dollars. Okay, the last step is actually just to place the order. So once you've picked the ETF you want to invest in, I'm picking a random one here just for illustrative purposes. Simply click buy. Decide whether you want to invest by value or number of shares. On Trading 212, you can invest in fractional shares. So if you do by value, you can invest as little as £1. You could say there really is no barrier to entry nowadays. You then simply review the order, and if you're happy, send the buy order. And when the markets are open, so if it's a London Stock Exchange listed ETF, that's 8 a.m. to 4:30 p.m. on a weekday, the order goes through, and that ETF, those shares, that value of that ETF will then appear in your account. And that's it. The process of placing an order and actually investing is pretty straightforward. And this is where most videos like this stop. But I want to go a bit further because when we were on that list, there were so many different S&P 500 ETFs to choose from. So how do you know which one is best and what exactly are the differences? So we're going to explain exactly that. I always think it's important to understand the nuances and the differences so you can make an informed decision. And at a bare minimum, you should be able to explain what exactly you're investing into and how it works. Before looking at some actual ETF options though, I'll quickly go through some key terms I'll be mentioning throughout. So first up, distributing versus accumulating. A distributing ETF pays out the dividends as cash. This cash lands in your investment account that you can then use to reinvest, to withdraw, whatever you want to do. On the other hand, an accumulating ETF automatically reinvests the dividends behind the scene. The fund reinvests it at fund level, and this in turn pushes up the share price. So the share price of an accumulation ETF reflects that performance increase from those dividends reinvested. Next up, replication method. This is how the fund seeks to actually replicate the returns of the index it tracks. There's a few different types of replication method. There's physical, full replications. This is where the ETF actually holds all the underlying stocks of the index, and therefore it replicates the index by having all those stocks. There's physical sampling. This is where the ETF holds a representative sample of the index, and the fund providers are usually pretty good at this. By just holding a sample, they can replicate the returns of the index pretty accurately. And the third one, which is a bit more difficult to get your head around, is synthetic swap-based. So with synthetic, they don't actually hold the securities that are in the index. Instead, they enter into a swap agreement with a counterparty that promises to pay the returns of the index in return for a swap fee and the returns of a collateral portfolio. We'll go into more detail about what synthetic ETF actually means later in this video when we actually go through one of those options. Next up, total expense ratio. This is the estimated annual cost of owning an ETF, covering management fees and other expenses. These charges can usually be found on the key investor information document, the fact sheet, or the fund provider's website, or many other resources. We then have fund size. This is the total assets managed by the ETF. Larger funds often have better liquidity and a tighter bid-offer spread. And speaking of bid-offer spread, this is the difference between the price you can buy a share of an ETF at and the price you can sell a share of an ETF at. So if you've ever wondered why you're immediately down after buying a share, it's probably the bid-offer spread. This is not a fee charged by your broker, it's just a characteristic of market trading. You can't avoid it. That being said, for S&P 500 ETFs, because the funds tend to be quite big and the underlying assets are quite liquid, the bid-offer spread is usually very tight and most people won't even notice it. But it is still worth knowing because there are differences between ETFs, and if you apply this knowledge to other ETFs that are less popular, bid-offer spread can be significant. I won't list the bid-offer spread for each ETF in this video because it does constantly change. It's not a static figure. Same with fund size, it's not a static figure, but especially with bid-offer spread, it changes depending on trading volume, how popular that ETF is. So there's no point in me really listing it. You can instead check it yourself using the London Stock Exchange website on the day you're looking to purchase. You'll be able to see the bid and offer prices and the difference between them. The closer those numbers are, the better the bid-offer spread. Okay, with the terminology out of the way now, let's explore some of the most popular S&P 500 ETF options on Trading 212 and what exactly the differences between them are. I'll be referring to the tickers for GBP listed ETFs in this video, but if you're a European investor wanting to buy in euros or you want to buy in dollars, you can use a website like justetf.com to see what the euro and dollar equivalent of the ETFs I'm talking about are. Okay, first up, I've got the Vanguard S&P 500 ETF. This has ticker VUSA for the distributing version, or VUAG for the accumulation version. This is the classic choice that everyone talks about, and in fact, it is the most popular ETF on Trading 212. This is likely due to the name recognition of the Vanguard brand, and as I say, the fact that pretty much all beginner investing videos mention Vanguard. Of course, whilst I don't think there's anything wrong with this ETF, Vanguard ETFs are quite competitive, there are other options available. And it's always worth remembering that most popular does not equal best. It's a physical replication fund, so it directly holds all 500 companies in the index, so there's no synthetic replication or swaps to worry about here. And the total expense ratio is 0.07%, so it is pretty cheap. In terms of fund size, as of making this video, according to Just ETF, the fund size of VUSA is 35.5 billion, and for VUAG, it's 16.3 billion. So these are absolutely huge ETFs. Remember, fund size is not a static amount and changes constantly as a result of stock market performance and the popularity of the ETF. But this is just to give you some idea of how popular and large these S&P 500 funds are. Okay, next up, the iShares Core S&P 500 UCITS ETF, ticker IUSA for the distributing version, CSP1 for the accumulation version. This ETF also uses physical replication, so it directly holds the stocks in the S&P 500 index. Expense ratio, just like Vanguard, this one has a 0.07% total expense ratio, which is low, but as you'll see, we're going to get even lower as we look at other options. In terms of fund size, it's currently at £14.6 billion for IUSA and a whopping £86.6 billion for CSP1. I could be wrong, but I do believe this is the largest S&P 500 ETF in Europe at the moment. The only real practical difference between Vanguard and the iShares S&P 500 ETF here is the fund provider. All these other details, the meaningful ones, are pretty much the same. So in my opinion, picking between these two ones, thinking about that is really not worth your time because there is pretty much no difference. Okay, moving on to the Invesco S&P 500 UCITS ETF. This is where things start to get a bit different. This has ticker SPXP for the accumulation version. There is a distribution version as well, but it does not trade in GBP, so I'm not going to mention it here, but you can look for it. It trades in dollars, so if you hold pounds or euros, you are going to have to pay a foreign exchange fee to invest in the distributing version. This one's different because it uses synthetic replication, swaps, to replicate the S&P 500. So synthetic replication, it enters into a swap agreement with a counterparty, typically a bank or another financial institution, and that bank or financial institution promises to pay the returns of the S&P 500 in exchange for a swap fee and the returns of a collateral portfolio that the ETF holds. The main advantage here is that a synthetic ETF avoids the withholding tax on US dividends, whereas the physically replicating ETFs are withholding taxes paid at fund level because they hold those US stocks, usually in Ireland. Most ETFs are domiciled in Ireland. Ireland pays a 15% withholding tax on those US stock dividends, so that's lost with physical replication ETFs. You don't know you've paid that is paid at fund level, so the return you receive is already with that withholding tax already taken. As I say, synthetic ETFs avoid that withholding tax, and performance may be slightly better over the long run. However, on the other hand, the downside is you have that additional counterparty risk, so the institution or bank that the ETF enters into that agreement with, if they default on that obligation, then you may not get the same return. But this is minimized by the fact that the counterparty is a massive institution usually, and they hold the collateral portfolio as kind of insurance. It's always worth doing your further research though, and if you decide to go with a synthetic ETF, make sure you actually understand what you're investing into. Moving on to the expense ratio, this one is cheaper at just 0.05%. And finally, fund size for the Invesco SPXP, it currently stands at £23.7 billion as of recording. So again, another massive fund. S&P 500 ETFs just tend to be quite big investments because they are so popular. Last, but certainly not least, we have the SPDR or SPDR S&P 500 UCITS ETF, ticker SPXL for the accumulation version or SPX5 for the distributing version. This one uses physical full replication like Vanguard and iShares. The big selling point here is the ultra-low total expense ratio of just 0.03%. That makes it the cheapest of the lot, and as far as I'm aware, it is the cheapest S&P 500 ETF for UCITS investors. I would quickly note though, at this level of fee difference, you're unlikely to see any major differences in performance. They're all very cheap, but I would not take away from State Street's achievement of offering the lowest fee S&P 500 ETF. I think it's great to see this competition in this space, and over time, it should constantly get fees lower as providers have to compete to try and attract retail investors like you and me that are obviously very fee conscious. In terms of fund size, SPX5 is £10.9 billion and SPXL is £6.3 billion. So I'm a broken record here, but again, another massive fund. When looking at S&P 500 ETFs, you're unlikely to encounter liquidity being a problem because they are popular. You're almost never going to struggle to sell your shares or buy shares unless you're buying and selling a huge amount. Okay, so now that we've broken down the details of each ETF, which one is right for you? Well, I can't answer that, unsurprisingly. I'm not a financial advisor. I can't tell you what to invest in. But I hope I've given you enough information to kickstart your research and helped break down some of that jargon. If you want the absolute lowest fee, then Spider's S&P 500 ETF may be worth looking into. If you like the sound of synthetic replication and avoiding withholding tax, the Invesco option may be worth looking into. If you like the sound of sticking with a big brand name like Vanguard and iShares, then those ones may be at the top of your list. It completely depends on what you give the most weight in your decision. At the end of the day, they're all low cost and they all track the same index, so you can't make any major errors here, but just make sure you understand the key details of the one you pick if you do go for it. And that leads me on to stressing the final point. This is not telling you the S&P 500 is suitable for you. This is simply breaking down those key details, differences between the ETFs. An S&P 500 ETF may have no place in your portfolio. That's for you to decide, and if unsure, consult with a financial advisor. For completeness, I will quickly mention that I didn't cover GBP hedged, currency hedged S&P 500 ETFs in this video. That is another option that you'll come across. They're worth considering, but it is a topic for another video, and I may do another video going into detail about currency in general, FX impact, FX fees, currency hedged ETFs, how currency fluctuations impact your portfolio more generally. If that's something you'd like to see, then let me know in the comments below. If you enjoyed this video, please consider leaving a like and subscribing for more content. As always, thank you for watching.